In this video, I want to talk about how to pick winning strikes for short strangles and short puts through technical analysis and obviously some few live examples. My name is Eli, I'm a professional options trader, and let's get right into the video. The most important thing when you choose a short strike for either a put or a short strangle is to analyze the graph technically and also look at what kind of expiration can give you what kind of credit. Ideally, you usually want to be, have a lot of cushion. So, the most ideal situation is for us to sell maybe the 46th strike, right? And, and then we have a lot of cushion until for the price to get to our short strike. The thing is, you usually cannot collect a lot of credit at strike 46. So how do you choose the right strike while still getting enough credit? So ideally right now, if you can see, we have a few bounces of the price at around 56, and I'm gonna look at only short puts currently. So if we take the short strike put at 56, this is still kind of too close to the current price, as you can see. So to be safe, I will probably try and go to maybe 54, 53. Let's try 53 for now, and let's see what kind of credit we can get, what kind of cycle we can potentially open, and based on this we can maybe move it down even more. But this is how I would, just by looking at the graph, what kind of strike I would be aiming to get. So in this case, if the price would have been way higher, I would have been okay just going to 56 or maybe 55. But right now, because the price is somewhat close to that lower end here, I want to be, I want to have a bit more space for my position. So if we go to strike 53 short put, let's see if we can get enough credit. And this is 40 days to expiration, right? So 40 days to expiration, we're looking at $490 in credit. Now for me, I will go for a margin impact of up to 30,000. So probably 4 contracts will be the most I can go for. And I can collect about 2% in credit, which is not bad at all. But obviously this is for some people not ideal. And, it depends on what is your strategy. But for me, I will take profits at 50%. And it looks pretty good for me. Now, usually I will probably go extra safe, and I will probably go to 69 days to expiration. In this case, we're looking at the February expiration. So let's look for crude oil February expiration. So right here. So let's see what we can get at strike 50, for example, here, because, strike 50 is way, way lower, and I would feel way more comfortable selling at strike 50 instead of strike 53, but depending on how much credit we can get. So it's strike 50 with 69 days to expiration. I can currently get, actually we can go up, take a few more contracts. We can probably go with 7 contracts, give or take. We are a bit over the 30,000 limit that I give myself. So 6 contracts, and you can collect about 3.2% in credit, which is quite good. And then if I take profits at 50%, let's say I have a $100,000 account and I open this position, I'm going to make about 1.6% on my total account with this trade. And we have 75 days to expiration. So we're looking at roughly 15 to 20 days, give or take, maybe a little bit more, and we can get this profit. So actually, I think, about 20 days. So that's not bad. So this is personally what I would go for. I would definitely want to go for a strike that is as far as possible while still getting good credit. And obviously, I don't want to open a position with 200 days to expiration. I want to stay as close as I can to the 45 days. And 69 days just gives me that extra cushion and the nice credit and still a pretty good data. So this is what I would do in this situation, for example, with a short put. Now volatility is really low, so this is why also we cannot go to 40 days to expiration and still collect a good amount of credit at strike 50, for example. So this can change obviously, but let's go for something a bit less, I guess, simplified. So if we go to soybean, right? So soybean, and again, I'm looking at selling some short puts, right? Soybeans, as you can see, it's been moving within a side trend for quite a while. You can see this is basically kind of the lower boundary. So I would probably want to go to strike probably 980, 990 at the very most, probably 980 ideally. So strike 980, and the price is really high, right? So I'm okay with just kind of keeping it just underneath this whole channel, and I never really want to go inside the channel. In some cases I would, and I will show an example of a position that I just opened up with where it's a short strangle, and you can see exactly what I mean there. But let's take a look here, and again, a short put, so it will be soybeans. So here we are with soybean futures. So let's go to 50 days to expiration. We have the January expiration here. So are we at the right contract? Yes, we are. So we're looking at the 980 strike. So let's see what kind of credit we can get with $980 strike. And as you can see, barely any credit. So $38 in credit, right? This is definitely not enough. So see if we can get a bit more credit, maybe with a different cycle with 78 days to expiration. And here we're looking at the March expiration. So let's go to soybean, March. And here, let's see here, I will be probably comfortable going, yeah, probably 990 will be just fine because the price is so far away. So let's see if we can get anything for 990 or anything worthwhile. So here we can get, $88, right? So that's not enough. So that tells me that this is not a position for me, and I don't want to go any closer because I don't want to increase my risk. The price is just way too high. If price would have been a bit lower or at the upper range of this side trend, if the price, let's say, would have been here at 1100, we would have got way more credit for the 990 or 980 strike, and we could have opened the position and been quite profitable by now, right? So this is just too far, and there's no point in selling it anywhere else. This is, if you decide to sell the, let's say, the 1040, 1060 strike, 1050 strike, 1040 strike, doesn't matter. If it's not closer to the bottom boundary, then you greatly diminish your probability of actually profiting on this position, right? And it's all about just going for the really good obvious positions. At least that's the case for me. So let me also show you a position I have on gold currently, and I did open a short strangle. So the way I chose these strikes is very simple. We can see gold had a massive run to the upside. Now on the downside, I wanted to be as close as I can to this side channel over here, as close as I can to the bottom of the side channel. So I didn't want to sell anything above it. I wanted to sell something ideally underneath it, but the credit was just not good enough, and I could just go a little bit up because the price is pretty far away. So I felt comfortable, but I don't want to go past the half point of this side trend over here. So I sold the 3400, and then to be equal distance on both sides, I also sold the same distance call option, which is 4700, give or take. Not, this is not super exact. I think when I sold the position, the price would have been here, so it's 16% to the downside if price moves. Yeah, it's almost the same thing, 16.14%, whatever, 16% to the upside. So it's pretty much equal distance in terms of percentage, right? So this is how I chose the call side, and it's, this choice was influenced by the put side because we don't have anything on the call side. This is all-time highs. We don't know where the price is going to head, right? And I'm happy that I'm way above the all-time high, and the price is so low that or the short strike, the short put strike is so low that it's basically on the bottom of the side trend where where gold kind of erupted out of. So this is how I would choose these strikes, right? And for this combo, for example, this position, I opened it, I believe, with at the time it was 84 days to expiration. So it was this cycle. The position currently is up like 25% right now, so it's already doing pretty well. But just to kind of give you an example or a feeling of how much credit you can get here, so 3,400 and 4,700. But I received about $2,300 in credit per contract. So it's quite a bit. Right now, if we do it, you can get about 1,780. So I received about 2,350 per contract. So quite a bit more, as you can tell. So this is obviously a good amount of credit, and I'm pretty happy with it. And the reason that I did not go with 47 days to expiration is, again, I wanted to get a bit more credit. Theta was still pretty good. So the difference between 47 and 82 days to expiration for me to stay in the position and profit at 50% of credit, it would have been an extra 6 to 7 days, right? So it's not that many days. Instead of being in the position for 12 days and 47 days to expiration, same strikes, I can be in the position for 18 days, 17 to 18 days, and collect way more credit and actually trade less contracts, which means less risk, and still gonna be pretty profitable and not expose myself to a massive amount of time risk in a trade. So this is how I choose my strikes. I think it's all very self-explanatory. Let's do another just quick visual analysis for example, copper. So this is just a demo position I've opened, but let's say we would just want to sell a put. So obviously you can see this is the lowest point we've had in a while. So this is this is where I would want to sell my short put ideally, or lower. I don't really care about what happened over here, but I do care where we are right now currently, and this is the lowest point recently in the past few months. So I would want to sell my put below that, right? Or maybe just a little bit into it, but ideally below that. And then if I want to sell a strangle, then I would just go equal distance on both sides if this is what I end up doing. But this is how you choose. I always choose based on the puts price, because this is where you usually have a place where you can choose where you can sell the short strike. Same thing over here. I think it's pretty obvious. If you sell a put, you want it to be at the highest at 510, and ideally you want to have it even lower, but prices increased, so we might be able with getting some good credit at 510, for example, because it's pretty far away, and it's a multiple, I think, year low, right? So it has a pretty high chance of profiting if you sell a short put over here. So everything is pretty self-explanatory here as well. You can easily see how you can choose your short strike. You would want to go anything below that, basically. And then if it's a short strangle, then you would go something equal distance at the very least. So this is it. Hopefully this video was useful. I think this is pretty easy. It's just a combination of technical analysis, and then from there you go to the options chain and see what kind of credit you can get for the strikes you chose, and kind of choose the different days to expiration to be able to collect the most optimal amount of credit depending on your strategy, and just go from there. So, and if you have any questions, let me know in the comments. Again, hopefully this video was pretty useful for you guys, and I will catch you in the next one.